Broadcasting from the 72nd floor of First Canadian Place in the heart of Toronto's financial district, this is #Finance, the podcast that profiles innovative entrepreneurs and thought leaders operating in the public markets. Presented to you by the CSE, the Exchange for Entrepreneurs.
Hi, it's Phil here from the CSE. We're here at the Media Center today with Peter Hodson, who is the founder and head of research for 5i Research. Welcome.
Thank you.
So tell us, our viewers, that is, tell our viewers a bit about yourself. You have a very interesting background. We've known each other for a little bit, but what is 5i Research and who is Peter Hodson?
Sure. I'm going to go way back. I bought my first stock when I was 11, and I made a lot of money. It actually tripled in a very short period of time. And then I took that profit, bought another stock, and then it went bankrupt. And so for the past 50 years, I've been trying to figure out exactly what has happened. And that's kind of how I ended up where I am right now. So I took some business courses in university. I got my CFA degree, and then I got a job on Bay Street. I started off as a credit analyst, and then I was looking at bonds, but equities are way more fun than bonds. So I shifted over to equities. And I got really lucky in the 90s. I worked at Mutual Life, which is now Sun Life. Mm-hmm. And the mutual funds were just booming. And everybody, I had a team of 13, and I was the junior coffee boy, basically, the junior analyst. And everybody just quit. They went to Toronto. They got offered more money in Toronto. They all left, and I kind of moved up the ranks way quicker than I probably should have. And then one day I found myself with $1 billion fund in Waterloo, trying to run $1 billion fund. And so that was a really, really big break. And then I went to a company called Synergy, followed that. That got bought by CI Financial. And then I ended up at Sprott, where I ended up as the chairman of Sprott prior to starting 5i Research.
So I recall a few years ago actually watching you on PNNs, kind of like through probably about 9, 10, somewhere in that range, because you focused a lot on resources, if I recall, right? So,
well, at Sprott was a pretty resource-heavy stock or shop, and so we sort of always had to have our toes in the resource world. But I've always really focused on small and mid caps. Most of the funds that I've run as a portfolio manager were exclusively small cap, and so much so that in many cases I could not buy a company that was above a certain market cap, generally $750 million.
So we usually encounter the other way.
That's right. And I mean, that was fun. I mean, I would rather find a company that no one else has heard about than look at Royal Bank. That would just bore me to death. But finding a little gem that, becomes the next big thing, there's nothing quite like that. And if you're early on that, of course, your investors are happy.
Of course.
But more importantly, you also get the kind of that pride. It's like, I was that person that picked that stock when it was $2 and now it's $100. That's a really, really good feeling.
That's good for your PA as well, I'm sure. So you're the head of research for 5i Research, which is I guess you would have left your background on Bay Street, but tell us a bit about how you got into that, why you transitioned to what you're doing, and what the company does.
Sure. So 5i Research was started really to be a different type of research company. We're focused on the do-it-yourself investor who really doesn't have that much independent help, and we wanted to start 5i. I say we; it was me when I started, but now I have a team of analysts. But when I started, the whole research world was kind of skewed against individual investors. The big 40-page research reports were tied to the institutions for the managers who could buy 1 million or 2 million shares. You had other newsletters that were out there, but there was always some sort of tie. They either wanted your money, they wanted to manage your money, or they were promoting a stock, or even worse, they were being paid by the company to talk about how great the company was. And you had all these conflicts. Even your broker, when your broker is selling you a stock, it's like, okay, is this something that's good for me, or is this something that's good for that broker's commission, or maybe that bank or the brokerage has some stock that they need to unload, and I'm the unwilling victim of buying that stock they're trying to unload. So I just wanted to throw out the whole model and say, I want to start a research company where we have no association with any company. We don't manage money. We don't get paid. But more importantly, we don't trade in any of the companies that we cover. And we've extended that even further. So we don't buy any Canadian stocks at all. So we're a Canadian-focused research company. we do not own anything in Canada.
Oh, wow.
And so
okay.
that just, so when we say we like XYZ company, we're not telling you we like it because we want you to buy it. We don't care if you buy it. We don't benefit if you buy it. We're really just offering our experience, our education, and our independent opinion. And when we started, it was pretty funny because I was retiring from, you know, a big role on Bay Street, and people are saying, like, why would you do that? And really, I wanted to help the individual investor. I know it sounds kind of crazy, but the individual investor just doesn't have that much help. They buy the wrong things. They buy IPOs. They buy closed-end funds, and they pay 5% commission. They look at target prices, and it's like, oh, my target price has been hit. I better sell. And then they have to buy something else, which might not be as good. The industry uses lots of jargon that tries to get you confused, and they try and make you look like they are the expert. Because if you're confused by an investment, then obviously you're more willing to give someone else money to look after your investments. But it's not that difficult. You need a balanced portfolio, you need quality companies, and you need the time. You have to put in the time to let those companies grow. And really, you just can't panic. And there's a lot of investor phrases and a lot of there's a lot of talking heads on the media that like you to panic because, again, if you panic, you transact. And if you transact, there's fees generated. So we just really are trying to throw out the whole model and say, this is what you should do as an investor. We're going to give you some advice along the way, and you'll probably end up doing much, much better than paying a really high fee to let somebody else do it.
Yeah, so I mean, in many ways, I think what you're trying to say is that you're helping the investor to take the emotion out of the investing itself.
Absolutely.
And then the byproduct out of that is you have the ability to be able to look at things in a systematic and theoretically objective way to kind of, come up with a future plan for your PA as well, or PA referring to personal account. And so when you talk about these types of companies, what are the types of things that you would address, let's say, in the most recent post that you might have done?
Sure. So there's really three services we offer. One is a model portfolio. We give you three sample portfolios that you can follow. If you really want to sort of, let someone else look after it, but you still do make the selections. So there's three models you can follow. We have a question and answer service at 5i Research where you can ask us any questions. And because we don't have a compliance department, because we don't manage money, we can answer those questions really, really quickly. And people just love that service. And we've answered 103,000 questions that are all posted on our site.
Say that again.
103,000 questions.
Wow.
Yeah.
How many years is it?
It's been about 8 years.
8 years. Wow.
And it's it's been really interesting is we have grown the company quite a lot, and we're concerned about the questions because if we have 1 million people asking us questions, we're going to be in big trouble. But it's been really interesting because the scalability of the questions is not the same as the scalability as our clients. So we could double the number of clients we had, but the number of questions might go up 5%.
Sure.
And we're kind of going, okay, why is that? And the reason is everybody's worried about the same thing. And so when there's a crisis in the market, as long as we answer it once and we post it publicly, then we don't get 1 million questions. And so it's been really interesting, so we can grow that way. But the other part of the business is pure research reports on Canadian companies. So we cover about 70 companies. And what we're looking for is companies that are well-managed, well-financed, not too small. We don't want the super micro caps. Companies that perhaps have a moat or a competitive advantage, companies where the insiders own a lot of stock.
A moat, like referring to IP or
something that makes them
intellectual property or patents or
absolutely.
Something like that.
So either a patent, or they do something different, they do something better, they have a different product, they have a lower cost, or they have a legal protection, or even, if you're talking about resource companies, there's a lot of Canadian resource companies that have done well by going into other areas. They go into areas that the majors don't want to go into. Sure, that's risky, but if they're successful, then they own that new area. And many, many companies have done very well in certain regions.
You mean
of
like as a start of an area play of sort, I suspect, right?
Absolutely. And again, some of these are sort of politically hot areas, but if you're a tiny company where you're not going to have an advantage, going into South Africa, you're going to have an advantage going into Mongolia. Sure, it's more risky, but when it works, guess what? You've now got inroads into that country. But it doesn't have to be so dramatic. It could just be a company that does something better or at a lower cost or has a new product or is developing, a new market where customers are sort of flocking to to their product and their service. And so we really like that, and we look at sort of all the fundamentals, and we look at all the quantitative measures. We look at the balance sheet, cash flow, growth. We are growth managers. We prefer companies that are growing very, very fast. And we're not value managers. A lot of people say it's too expensive. It's 20 times earnings. I'm not going to buy that. We can't stand that phrase, because if you've got a great company, it really doesn't matter so much what you pay, as long as that company remains in a growth mode and remains a great company for 5-10 years. It's going to grow into that valuation. So a lot of people, they miss out on fortunes because they're trying to get something cheaply.
Right.
And we've learned over the years that you can lose $100 by trying to save a nickel. You say, I want it at $9.50 instead of $9.75. Well, if you put yourself in small cap world, if you're buying a company at $9.50, you're not buying it for a 5% return. You want a double, a triple, a 10-bagger, or even more than that.
Yeah.
And so to be all concerned about a 25 to 30 cent difference when you're expecting a double or a triple or a quadruple doesn't make any sense.
Yes.
And so that's one thing we've
sense.
helped our clients with. I mean, one of our big mantras is don't sell too early. And so many individual investors, they'll get a gain on a stock. They'll have a stock that goes up 100%. And they're like, yeah, party time, I've doubled my money. And we turn it around and say, okay, the investors that are buying that stock today, they are expecting it to go up. So what are they seeing that you're not seeing?
It's a good way to look at it. Yeah, that makes complete sense. So of the 70 companies that you cover, are they certain sectors or so you offer solutions right across the board?
Yeah, I mean, we're trying to focus on companies that we like. So we're not really looking to go into any sector specific. So if we like it, we like it, whether it doesn't matter what you do. We specifically tried to avoid some of the junior resources and the energy companies when I started off. Largely not so much because we didn't like them, but because that's well covered in Canada. So we wanted to cover companies that just don't get a lot of attention, but are great companies.
Yeah, that makes sense.
We've also come up with a bit of a niche covering new companies as well, so new IPOs, because in Toronto and on Bay Street, you don't get a lot of research on new companies. There's regulatory restrictions about what the underwriters can say, and of course it's a new company and the poor investors never heard of it, and so we try and fill that niche as well. So we do cover all sorts of companies right now. Primarily industrial and tech is kind of our playing field, and that's where we've done well and hit some good success. But we'll cover it all if we like what we see.
Okay, let's maybe take a little turn here, and aside from talking about 5i, I want to talk about maybe like the year that just passed, 2019.
Sure.
Love to get your viewpoints on, what type of lessons did we learn in 2019? And then moving forward for 2020, what can we look to expect? We're looking at a series of things that are happening on a geopolitical scale. Iran's conflict, gold has had quite the run over the last little while, but I'm hearing things about palladium as well. Those are just from a commodity standpoint, but maybe if you can touch a bit about on the where you think the Canadian market's going, and maybe a bit about the U.S. as well.
Sure. I guess the first statement I would make is, and I've learned this over 40 years of investing, there is always something to worry about. And in fact, if you're not worried, that's the time that you should sell everything. And so, every single year that I've ever been an investor, there's always been a crisis, whether it's Asian crisis, currency crisis, long-term capital. I could go back because I'm getting pretty old. Yeah. But there's always something to worry about. But if you focus on the actual companies and the actual economy, then the rest of it is really just noise. And so we like to focus on earnings and interest rates. Those are absolutely the key. And last year was very confusing because we started the year following, a really horrible fourth quarter in 2018. Everyone thought there was going to be a recession. Everyone thought there was going to be a horrible market, and then the market goes up 30+% in the U.S. But if you were looking at the economic data, it wasn't that bad. Sure, earnings growth slowed down a little bit, but everybody's got a job if they want a job, and interest rates are historically low, and there's no inflation. So we weren't really too concerned about a big panic. And then I've got to talk on that as well. If there's a recession, and this sounds flippant, but really, who cares? Like, there's always a recession. There's always coming one around the corner. And the average recession is about 9 months or 10 months. And the average dip in the market is not very significant. So if you have perfect timing and you can get in and out and buy at the exact right time and the right stocks to sell and the right stocks to buy and pay taxes and transaction fees, which of course are going to zero anyway. But if you can do that all perfectly, good luck to you. But over a 9-month period, it's pretty hard. And during that time, you're going to lose some dividends as well from your portfolio. So if you've got a time frame of more than 5 years, really, who cares about the recession? What investors are doing, though, is because the last recession was so bad, it was bad in 2008, don't get me wrong. The memory of that, everyone thinks the next recession will be as bad as that.
Right.
And if you look at the past 50 recessions, that was an aberration. It really, truly was. We were sitting in our offices at Sprott and the world was ending. The Bank of England was going to close. I mean, it doesn't really get much worse than that. The next recession, you might have an uptick in interest rates. You might have an uptick in unemployment. No big deal for an investor with a decent time frame. So this year, the big issue is the election. But everything else looks okay. You're going to get a growth recovery from earnings because last year was flat following the tax cuts in 2018. Valuations, and again, this is another interesting point that historically has been proven to be kind of a harbinger. Everyone looks at the valuations right now and they say, oh, it's an expensive market. And it's expensive because it has gone up. But again, put yourself in the buyers. The buyers today are not expecting to lose money.
Right.
What do they see? They see low interest rates. They see high employment. They see corporate growth, corporate earnings starting to recover, maybe even 7-8%. They see an election where Mr. Trump's not going to send out any bad tweets between now and November. And the thing that we've really tried to work on a little bit at 5i is, and this I don't think is very widely known, in the North American public marketplace, there's about half the companies that there used to be. Through takeovers, there's companies that are being privatized. I mean, if I had told you last year that WestJet and Cineplex were going to be gone from the public market, you would say, well, that's crazy.
Yeah.
But sure enough, they're disappearing. And so you've got a whole generation of wealth. You've got everybody having a job. You've got money that's freely available and low interest rates. And just from pure supply and demand, if you go back to Economics 101, you've got all this money and you've got half the number of actual stocks you can buy. It's not really surprising to us that there's sort of this surge of buying. It's not going to last forever and valuations are what they are. Who knows what they're going to be in the future. But I think any dip, if we have this year, will be met with some buying because a lot of clients see what happened last year. They were bearish last year and they missed out on 30%. So now if you're a money manager, you might lose a bunch of clients if you fall behind the market. And so you're going to be supporting the market with cash this year if there's a dip. So we're not really that concerned right now what's going on in the markets. I would expect a pretty good year. I don't think we're going to go up 30%, but I think the underlying themes of growth, takeovers, privatization, low interest rates, I don't think anything changes there.
Right. Thank you for that. That was very, very insightful. I want to kind of also switch to, because I understand that a lot of the U.S. growth at this point is fundamentally driven by FANG, which are Facebook, Amazon, Netflix, and Google. I'm wondering if you can provide, and usually we don't talk about actual stocks here on this podcast, but it's kind of a big theme. So what are your thoughts about FANG? Do you think that's going to potentially continue? And what should we be looking for?
Sure. I think there's really two things that are happening there. So one is the move to passive investing is really helping the FANG group. So every dollar that goes into a passive ETF, a lot of it ends up in FANG because of the high weightings of those particular companies. So, as investing comes through, whether it's a pension plan or just an index ETF, there's a flow of money into that group that's not going to stop until the market totally reverses. But the other thing is really they're becoming more dominant. Sort of, it's like the biggest company wins everything. And obviously the government is starting to watch that because the dominance of somebody like Amazon or Facebook is starting to be, a bit of a problem, at least from a political landmine point of view. But it's really, I don't see another search company competing with Google. It's just not going to happen.
Right.
I don't see. I mean, Facebook has 2.5–3 billion customers. It's pretty hard for someone to sort of take that dominance away. And so it's a situation where these companies that have historically not made a lot of money might start making just massive amounts of money. And, you may go from a multiple of sales to a low multiple of earnings. So I don't really see the group cracking much. And even if the government comes by and says, you have to break up, I don't even know if that's bad for those stocks because some of the individual divisions of these companies are growing faster than other divisions.
It's a good thought. I think that when PayPal actually broke off from eBay, a lot of valuations was, for lack of a term, unlocked as well.
Absolutely,
right? So,
absolutely.
Yeah.
So I don't, they'll move with the market, and they're high beta stocks. And if the market goes down 20%, they're going to go down 30 or 40. But you also they're all very, very powerful in terms of balance sheets as well.
Sure.
I guess the one thing that might throw a few things off is I don't see a lot of those companies making big acquisitions. And they know they're being watched by the government. And if they were to come in and make a $10 or $20 billion acquisition, I think the government would kind of perk up their eyes a little bit and say, okay, how powerful are we going to let these companies become?
Yeah.
And quite honestly, they have so much cash, like they could do it. Apple could buy, a $50 billion company and not even notice it. And they wouldn't even notice the dent in their balance sheet. So I think that, that takes away a little bit of some of the M&A activity, but at least it provides some opportunity for other companies to at least be around.
Yeah, good point. So aside from Peter Hodson, the 5i director or head of research, what do you do kind of personally to relax and stuff like this? So we're going to get into the human aspect of this podcast here.
Sure. Well, I have 4 children, and so for the first 20 years of my career, I really didn't do that much other than look after the children and go to work. But now my kids are a little bit older, and they can look after themselves. So I'm a pretty big swimmer. I've been an active swimmer forever. I do open water swimming.
Wow. Okay.
This summer I crossed the Northumberland Strait. I swam from New Brunswick to PEI, 16 kilometers. It only took me 4.5 hours.
Wow. That is impressive.
Yeah, and I love bike riding. I biked across the Pyrenees, and actually in my life I've biked across Canada twice. I've gone both ways.
Oh my gosh, that's amazing.
Younger and more foolish. But
how long did that take?
Well, the first time was in '86, and I was with a friend, and we had quit our jobs, and we wanted to go to Expo '86 in Vancouver, and that took 92 days because we kept stopping and having fun. Wow. We stopped in Montreal for 5 days, and we stopped in Banff for 5 days. The second time was for charity, and I was on a very fast racing team, and all we had to do was bike. We had a mechanic, we had a nurse, we had a massage therapist, somebody did our laundry, somebody cooked for us. We did that in 17 days, the other way from Vancouver to Halifax in 2014.
Very impressive.
And so I combined my love of biking and swimming, and I thought, I should do some triathlons because I got 2 out of 3. Unfortunately, I'm still waiting for the running to get better. But generally, I do pretty well, and then everybody passes me on the run, but it keeps me out of trouble. And then, I'm a big movie buff. My wife wanted to move about 8 years ago, and I didn't want to move. And part of the deal was I got to build a movie theater in my house. And if I have any spare time, I'm down there.
Oh, very cool. Very cool. So that is really interesting about the tries because I've actually done a few myself, but they're less in stature. They're just really the tries. But having said that,
it's still fun.
I swam competitively in high school, and then the running kind of came along, and then the biking part was actually my worst part.
Okay.
So
we could form a relay then.
Yeah, we could form a relay. Yeah, that's right. But I want to thank you for your time today. This is really, really exciting to get to see you again.
Thank you.
To certainly do this. Once again, it's Phil here from the CSE. I'm here with Peter Hodson. One last question, actually. How do people keep abreast of you and get in touch with you?
Sure. I mean, so our website is 5iresearch.ca, and we have a Twitter feed as well, which people seem to like. We tweet out all the dividend increases, which you can't really seem to get very easily anymore. But that's the easiest way is through the website. We have free trials, and again, we're not doing it for the money. We're doing it to help investors. I made my money on Bay Street. That's not the goal anymore.
And how much is it?
$176 a year.
Which is just under $15 a month.
Yes, that's right.
That is probably the best deal you're going to get from a finance standpoint. So thank you very much. And it's Phil here from the CSE, here with Peter Hodson.
We're social here at the CSE. Each and every day we'll keep you up to date on trending topics that investors are talking about, such as cannabis, blockchain, and esports. Follow daily CSE news and events on your favorite social media platform: Twitter, Instagram, Facebook, LinkedIn, and YouTube. You'll find exclusive interviews with leading entrepreneurs from a variety of industries, thought-provoking stories from across the world of finance, and updates from CSE events taking place worldwide. Join the conversation and connect with us today.